Hey soldiers, looks like more banks have been downgraded. Another rating agency is getting in on the fun. What does this mean for us? Now I'm going to tell you something. The large banks are loving this. The JP Morgans of the world, the Bank of Americas, they love these downgrades of these regional and community banks. And I'm going to tell you why. It's contrary to what you've heard. I'm going to tell you exactly why they want these banks to go out of business. But first, let's talk about S&P. That's right, Standard & Poor's. They are actually out there downgrading banks, and there's some major names among the banks that have been downgraded. And remember, Moody's has said that, they downgraded some banks. Fitch, we've covered all of this. They are considering downgrading the entire industry. What's going on with banking these days? Do you feel confident in your bank? Drop me a note in the comments section. Just let me know. Do you feel confident in your bank? 2 weeks after Moody's slashed ratings of regional banks on a triple whammy of factors, now S&P Global Ratings is joining the downgrade party. S&P is painting a grim picture for even more lenders due to higher interest rates and deposit outflows, according to Bloomberg. Let me tell you guys a little story. I applied for credit to purchase some equipment for business purposes. I was approved, but I was unsatisfied with the rate at which I was approved. So I did all this on the internet. I called them and we, talked about it a little bit. And I said, listen, I can't do this rate. This is exorbitant. I don't think that this is fair for me given my situation and my history. And they agreed. All right. So you can ask. When you're out there applying for credit, you can certainly ask them to adjust the terms. Don't just take what is initially offered. I think most people do that and just think, hey, what they gave it to me, I got to take it. No. Inquire. All right. S&P wrote in a research note that a tough lending environment forced them to downgrade 5 banks. Those banks are KeyCorp, Comerica, Valley National Bank Corp, UMB Financial Corp, and Associated Bank Corp. One notch, they downgraded them one notch, citing negative outlooks for River City Bank and S&T Bank also. The rating agency said the review of Zions Bank Corp remains negative. So more and more community and small banks are getting hit with this. The reason for the downgrades is because depositors, you and me, have, quote, shifted their funds into higher interest-bearing accounts, increasing banks' funding costs, unquote. Right. Who wants to put their money? People have been watching Soldiers of Finance, I tell you, because who wants to put their money somewhere where it's not even getting 1%, yet and still the bank is taking that money on a fractional reserve basis, loaning it out and getting on credit cards upwards of 20%, 24%, on mortgages? Some of these mortgages are touching the 6% range or higher. Car loans. Okay, so you're going to take my money. You're going to keep it safe for me, right? Okay, right. And in exchange for that, you're going to give me what? 0.25% interest? No, thank you. So people are seeking alternative vehicles to put their money in quite naturally. Otherwise, when you account for inflation, you're actually losing money. You can't afford to put your money in a bank. It's going to lose money, right? Especially over the intermediate and long term. So the decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen. Here's another thing I want you to do. Put in the comments whether or not you've gone into a bank and tried to withdraw money. How did they act? Was this a small bank? Was this one of the larger institutions? How did they act when you went in there to withdraw that money? Did it inspire you, their behavior when you asked? Did it inspire you with confidence in the sanctity and economic viability of the bank? Let me know. S&P's downgrades come 2 weeks after Moody's slashed their ratings on 10 small and mid-sized banks. It cited higher funding costs, potential regulatory capital weakness, and rising risk tied to commercial real estate loans as the reasons for the downgrade. Moody's analyst Jill Cetina and Anna Azarov wrote a note in which they said U.S. banks continue to contend with interest rate and asset liability management risk, with implications for liquidity and capital as the wind down of unconventional monetary policies drains system-wide deposits and higher interest rates depress the value of fixed rate assets. In plain English, all that stimulus money is almost drained out of the system. Inflation is so high that Americans have had to take any savings they had and devote it toward living expenses and paying down high interest credit. So therefore, there's not a lot of money to be deposited into these banks. It's basically the plain English version. They gave you the 8 years of Harvard version, but we do it a little differently here on Soldiers of Finance. Moody's also warned there's more pain ahead. We continue to expect a mild recession in early 2024, and given the funding strains on U.S. banking sector, there will likely be a tightening of credit conditions and rising loan losses for U.S. banks. Now, when any of these Wall Street cats say a mild recession, that means that instead of getting 2 pounds of caviar, they might only be able to afford 1.5 pounds. But for the rest of us, their version of a mild recession could result in layoffs, people actually losing income. That is why it is important for you to pay down that high interest debt. I want to say right here, if you got $10,000 of debt or more, you got to visit mcenow.com/get debt free. We'll hook you up with a Debt America qualified debt resolution expert that's going to help you get rid of that so that you can build up assets and have a cushion, all right? Instead of paying the credit card companies, the banks, all right? They want to pay you a paltry amount of interest, but they're not charging a paltry amount when it comes to those credit card interest rates. Earlier this month, and we talked about this, Fitch Ratings downgraded the U.S. government's top credit rating. Everybody's getting their credit rating downgraded. Last week, Fitch analyst Chris Wolf told CNBC another round of turmoil could be nearing for the banking industry. He said the ratings agency is mulling over sweeping ratings downgrades for dozens of banks, including ones as big as JP Morgan Chase. And let me tell you why JP Morgan they're willing to ride that out, okay? They're not bothered by that. Same with Bank of America, Wells Fargo. These heavyweights, these national bank chains are not worried at all, even if they get downgraded, because they would be fine with taking the ride down a notch or two in terms of their rating if it means that's going to put an extreme amount of pressure on the regionals and the local banks. Because once they dry up, then the big boys kind of become the only game in town. Now, here's where some people get a little twisted, I think. Some people are saying, yeah, well, these big banks, once they're the only game in town, they're not going to lend to anybody. They're going to lend to everybody. And the reason they're going to do that is because debt is what powers their bottom line. They don't mind having more debt slaves, okay? And furthermore, the fewer regionals and community banks that are out there, that means the less competitive the big boys have to be in terms of the terms that they offer for these loans that they're extending. So this is great. This is actually a good news story for the big banks, but it's not good news for you and me, people who need to borrow money. Because the other thing about the regional banks is they're less impersonal. You can pick up the phone and you can actually speak to decision makers at your local credit union or your community or regional bank. I certainly did. When I told you guys I called Fulton Bank to ask them what the hell was going on with the downgrade, okay, I eventually spoke to someone who was, high up in the food chain, and they gave me the, standard pat response, and that's fine. I didn't expect them to give me any, Tyrone, listen, don't tell anybody else, but here's what's really going on. I didn't expect that. But the chances of me picking up the phone and reaching anywhere, I'm not the person who comes into Jamie Dimon. He's the CEO of JP Morgan. The person that comes into his office at the end of the day and empties the trash pail, I'm not even going to be able to speak to that person. All right. That's how lofty and unapproachable JP Morgan is. The guy that is hanging outside of JP Morgan, Jamie Dimon's office, washing the windows, he's not even going to accept my call. All right. That's how impersonal the big banks are. I told you I walked into a big bank branch a while back, tried to start an account at that bank, a business account, and they said, hey, sure, we can make an appointment. How's next week look? Next week? I want to give you some business. They didn't care. As soon as we got this next week, buddy, take it or leave it. I left it. Went to a community bank. All right, so that's what's happening right now with the latest round of bank downgrades. Stay on it, guys. They're in this situation, part and parcel, because of these interest rate hikes. And guess what? The Fed is not done. Watch this video. It will explain to you why we can expect higher interest rates coming up shortly. Guys, I'll talk to you soon.